Assalamualaikum, ladies and gentlemen. Today I'm very happy to see you, and I am going to show you how interesting accounting. We have a different approach here, because we use color to help the user or to help the student to understand accounting better. We have more colorful accounting here, we call. Okay, what we have here, right? Yeah. Okay. First of all, in accounting, we have debit and credit term. To make the student understand better, we put color for the debit and for the credit as well. Alright, okay. The first one, for the debit, we put yellow color. And then for the credit, we have a magenta or pink color. That's a representative for debit and credit in my show today. Alright. So while we have color here, actually we are copying the sample that used in the traffic light. Yeah, the traffic lights actually using all those color to signal fast information about the stop and whatever activity in the regards with the traffic light. Alright. So here remember, for the debit we have yellow, for the credit we have pink. Alright. So next, what we have here, we have assets, equity, and liability. This is actually the main or base accounting equation. Alright. So accounting equation, we have assets. Okay. And then asset with the color yellow, which is debit. And then we have owner's equity and liability credit. Right. So here, all the asset must actually the meaning of the accounting equation, we have asset must come from or financed by these two entities we call owner's equity or the owner, and also is the liability, they are credit balance. So one thing we have, this debit must equal or balance with the credit, right? So another term, another name, we have asset equals to equity plus liability. So how the beautiful, see how the beautiful color we have here. Alright, so as time goes by, the business should do some business operation, right? From there, we have an expansion of accounting equation we call assets. Here we have in the cloud, right? Must equals to capital, which is actually part of owner's equity. And then now we also already have revenue. Yeah? For the revenue, we have a credit. Why? Because the effect of credit to the owner's equity, it increases the owner's equity, it must have a credit. Why? Because the owner's equity original is a credit balance, right? Okay, next, in order to earn the revenue, what the business is to do is to do the sum, to incur some expenses. So the expenses is a debit. Why expenses is debit? Because of the effect to the owner's equity. Right? The debit actually is reduce the owner's equity. That's why it's debit balance. And then the liability remain as a credit balance, because that's the rule. The liability must have a credit balance. Alright? So this is actually is the expansion of the accounting equation. Very simple. Alright? So now if you look at the asset, we have a few assets named like building, premise, land, office equipment, motor vehicle, machinery. They are all debits. Why? Because that's the rule. Debit actually for the assets. In order to increase the asset, we have to put more debit. Right? So this we group in one category because they all have the same character. We call it non-current asset, which, for example, the useful life is more than 1 year. And then the cost can be measured reliably, and these assets are used in the business for business operation, business activity to generate the income. That's a non-current asset definition. Alright, but as you can see, this non-current asset, we have one button here, which is credit balance, or red, or pink. So this is we call accumulated depreciation. And this accumulated depreciation have a credit one because it reduces the asset. That's the rule of credit. Credit is to decrease the asset, increase the owner's equity, increase the liability. Okay, everyone? Got it clear? Alright. So now here in other asset also in one group, we also have another assets in term different character. We call it inventory, cash, bank, and debtor or receivable. So these assets also have a debit balance because of the rule, remember? And then but we have one button which is credit balance. Why? This account is named as a provision for doubtful debt. Provision doubtful debt have a credit balance because it's reduced the trade receivable only. Whereas the accumulated depreciation actually is a credit because it reduces all the except land. That's following the MFRS 116. Alright. Okay, so we have another asset, right? Revenue, receivable, we have prepayment. This is all non-current. This is the current asset. Alright. Okay, now we proceed to the capital. What is the capital? It's a credit balance. Actually, it's a part of the owner's equity, or this is the original capital invested in the company by the owner. And then under capital column here, we have a drawing which is debit. Why? Because reduce the capital, and we have increase or additional capital credit because it's increased capital. See how easy the debit and credit actually applicable in accounting. Alright, so next we have revenue. Yes, what is revenue? Whatever you gain in your operating the business. Why? Because you operating the business or you operate business because you want to increase your revenue. One of the main character of the revenue is the sales, right? So let's say you have a merchandise, you want to sell the merchandise, so you make a sale. It must be credited. Why? Because it's increased the revenue, right? And then we have sales return here next to the sales. It's debit. Why? Because it's reduced the revenue. Yeah, once you sell to the customer have the right to return back the goods. We call it sales return or return inward. So it must have a debit balance because it's reduced the sales account, right? So we also have a discount allowed. Discount allowed is a discount that you give to your customer. So once you give discount, actually you reduce your sale, it must have a debit balance. So this is all the primarily effect on the revenue. We have your sales, we have debit, sales of return, discount allowed. This is reduced, mean you have minus, and all this actually leads to you to calculate your net sales for the year, for within 1 year accounting year. Alright, so in order to get these sales in the business, what you need to do, actually you have to incur costs, right? For example, you have opening stock, right? So this opening stock is categorized under expenses. So it must have a debit balance. This is actually the unsold stock from last year. So you have your goods, and then you need more good, you do your purchase. This is also part of your expenses. It must have been called purchase or debit balance. And then we have purchase return credit. Why credit? Because it's reduced the purchase, right? Reduce the purchase. And then we have carriage inward, debit, import duty debit. This is all actually part of expenses. Then you have your discount receipt credit because it reduces your purchase. And then you have inventory credit because you want to calculate your cost of sales. So now actually this is the most common item in order to calculate the cost of sale. So from here you have your net sales and your cost of sale. Once you match these two, net sales and cost of sale, what will you get? Actually, that's what we call gross profit. So this region or this area is to calculate the gross profit. Clear? Very simple. Okay. Next, once you have all this, a gross profit calculated, you proceed to other income. Yeah, your business may also do some extra business in order to have more income. We call it rent receipt. Maybe you rent out some of the space in the business, right, or in the shop to tenants, so you receive rent. So you have commission received. Maybe And then you have your gain on disposal, interest received, dividend received. This is all the revenue or other revenue that business may get throughout the accounting year. Right? So once you have the gross profit, you add to the other revenue because it's increased revenue, which is credit. And then you have your other expenses. Remember, your cost or your expenses is not only cost of sale, but you also have to incur other expenses. We call it insurance, carriage outward, electricity, salary, utilities, stationery, bad debt, rent and rates and advertisement. This is all the example of expenses incurred within 1 year to support the business operation, right? So once you have your gross profit, what you need to do, you add your other revenue and then you minus your operating expenses. All this actually leads to net profit. Alright, so this actually must all the account about the transaction in the business must be shown clearly in one report. We call it statement of profit or loss. Very simple one. Yeah. So statement of profit or loss, you must show how much is your gross profit and how much is your net profit. Once you get net profit, what will happen? This net profit must add up to the capital. Alright. So any gain or losses made by the business must earn or goes to the owner or the capital. Alright, so once you're done, have your net profit. Next, you have to settle all your liability. So the liability is the same as your asset, categorized into two types. We have non-current liability, which is an obligation of the company to pay the debt more than 1 year. This is an example. Bank loan, mortgage and bond. We also have current liability, the obligation that company or the shop must pay within 1 year or less than 1 year. We call it bank overdraft, revenue in advance, creditor and accrued expenses. And all this information showing the assets, the capital, net profit. If you have the net profit and the liability must be shown clearly under statement of financial position. So ladies and gentlemen, what we have here actually is a clear picture. It's like a helicopter view to see everything in accounting or in the business affair of the business or the entity or the shops, right? So here, if you let me show you how the debit and credit should be implemented here. I have the debit button here and I have a credit button here. Okay, let's say the business make a sale. So what we need to do, we have to credit the sales, right? Put a button credit over there. So in accounting, we have a double rule. We have double entry rule, which is one you debit, one thing you have to credit. So once you debit the sales, what is the account which is suitable to pair with the sales, right? So here you have to debit something. Okay, let me show you which one is good, right? Okay, let's say you have a cash sale. So once you have a cash sale, actually you credit sale, you have to debit your cash. See? So that's how debit and credit means. Increase your cash, increase your asset, debit, increase your sale, increase your revenue, increase your owner's equity, credit. Alright? If you have cash sales, credit your sales, debit your cash. If you receive check, you need to debit your bank. Right? Then if you sell but you don't receive anything because it's sales on credit, what you need to debit is a trade receivable or debtor over there. So most of the time for the sale we have these three accounts which is used to have for the transaction. Alright, so now let's say you have salary. So we debit the salary. What is this supposed to mean? There's an increase of salary, increase in expenses, reduce on equity. It means increase your expenses. So once you debit, next what you need to do is credit. So what is the common account used in order to pay with your salary? Alright, so let me show you. If you pay the salary by cash, so you have cash. So you credit cash. Simple as it is. Mean reduce your cash. If you pay by check, you need to credit your bank. Right? Check mean whatever money in the bank. Right? If you don't pay, mean your salary incurred, but you accrued the payment, mean it's not paid yet. What you need to credit is you credit your accrued expenses. It becomes your liability to the employee. Simple as that. Alright? Okay, now let me show you another very good example. Alright, let's say you have a credit inventory. Yeah? Why you credit inventory here? Because inventory, another name for closing stock, mean unsold stock. End of day, you have to take out from your cost of sale because it's not your cost, it is unsold stock. You have to keep it in the business for the next transactions, right? For the next year transaction. So what you need to do is to debit one account only. We call it inventory or closing stock at the end of the year, falls under current assets. But remember, ladies and gentlemen, we have inventory here as a credit for the cost of sale. The only double entry is a current asset. It cannot go with other, just like we have for the other item, especially for the expenses. Alright? Okay, let's say there's another good example. Let's say you have provision for accumulated depreciation. You credit the accumulated depreciation. So what is it supposed to mean? Some depreciation happen leads to a decrease your asset, you must credit. Every year, all the time under MFRS 116, you have to reduce the asset. So once you credit, what account you have to debit? Right? So the account you have to debit definitely goes to the depreciation. Oh, sorry. This is, you make some error because that's our credit. You have to debit the depreciation. Alright, so this is actually tools that we use in the class to help the student see clear view. That's what we call it helicopter rides. To see the whole picture, and then with this you can see how the transactions should be recorded using the double entry, how they affect actually to the whole business transaction in the clear picture of accounting. Alright, so since that's all we have actually, showing the debit and credit and the effect of accounting. And then I want to remind you, actually this is a simple accounting, or this is actually focused on the financial report of sole trader. We also have other accounting report which is more interesting, is partnership and company. But for that accounting, for that report, we will get back to you later. That's all. Thank you. So please enjoy our accounting, the colorful accounting. Assalamualaikum.